Good afternoon, everyone. Welcome to the Employee Retention Tax Credit Eligibility and Tax Benefit, the second program in Cohen & Company's 2021 Virtual Summer CPE Series. Thank you for joining us. Before we get started, we would like to review a few housekeeping items. My name is Jennifer Novotny, and I will be your technical host for today. If you have any questions or challenges throughout the webinar, please send a message using the chat feature in your WebEx window and send your message to the host only. This webinar is eligible for CPE. In order to earn CPE credit today, you will need to be on the webinar for at least 15 minutes, and you must answer 3 out of the 4 polling questions during the webinar to receive full credit. The polling questions will appear on the right-hand side of your WebEx panel throughout the webinar. You will have approximately 2 minutes to select your answer once the poll is opened. Please be sure to hit submit once you have answered the question. Please submit questions through the chat feature in WebEx to all panelists. We will try to answer as many questions as possible. We will follow up directly regarding any questions we are unable to get to in the allotted time. CPE certificates will be sent next week to the email you provided at the time of registration. We are recording today's session, and a recording along with a copy of the materials will be available on the Cohen & Company website later this week. Please note, CPE credit is not available for watching the replay. CPE will only be awarded for those attending the live presentation. I would now like to turn it over to Nevin to get us started.
Awesome. Thanks, Jennifer, and welcome to everyone. So today's session is a refresh on the Employee Retention Tax Credit Program. And based on the amount of questions and discussions we continue to receive on the topic, we felt like it was worth revisiting in the summer CPE series. My name is Nevin Nussbaum. I'm an audit partner with the firm, and I'll be the moderator for today's presentation. I've personally spent a lot of time consulting on the topic and trying to understand the practicality and application of it. Joining me today are two gurus in our tax practice, Robert Venables and John Williamson. Certainly lean on them heavily from a technical perspective, and they're great at what they do. In addition to the prepared material, as Jennifer said, we will have time for questions at the end, so make sure you put those questions in the chat box to the panelists, and we'll be happy to get to them. So with that, Robert and John, take it away.
All right, thanks, Nevin. And to anybody logging in, I guess that isn't too familiar with the ERTC, it's the Employee Retention Tax Credit. Came out as part of the CARES Act as a incentive for employers to continue paying their employees through hardships of COVID-19. To qualify for the credit, there was a number of different tests and different qualifications that were issued that have actually altered from year to year or quarter to quarter, depending on when you're trying to qualify for the credit. So the way we're going to do this presentation is first by covering some of the core concepts that apply no matter what quarter or year you're looking at, and then we're going to go into a little bit more detail on each period and what specific rules apply to those periods. So there are two main qualifying factors to determine if an employer is eligible to claim the ERTC. The first of those is whether or not the employer experienced a full or partial shutdown. So generally, this is going to include any orders, proclamations, decrees from a federal, state, or local government, and that order has to limit commerce, travel, or group meetings. And the limitation on those items needs to relate to a suspension of an employer's operation of its trade or business, or a partial suspension of an employer's trade or business. The rules and the notice that the IRS came out with have identified that if you're looking to see if you qualify as having a partial suspension of a trade or business, there are some bright line tests that have been provided. Basically, if the portion of your business that you're trying to determine if it's more than a nominal portion of your trade or business, it needs to either A, have gross receipts of at least 10% of the total gross receipts of the employer, or the hours performed by employees for that portion of the trade or business need to be at least 10% of the total hours performed by all employees of the employer. So if you're looking at a portion of your trade or business and whether or not a governmental order that shut down or partially shut down the operations of that portion are significant enough to qualify, those are the tests you'll want to look at. So one of the examples that they provided in the notice on this was if you were a grocery store and you still continued operations through the pandemic, but due to government regulations, you weren't allowed to offer basically your salad bar. But when you look at the gross revenue provided by that salad bar in comparison to the total and the hours worked of employees, for that salad bar in comparison to the total is well under 10%. So the IRS would say that's a nominal portion of your trade or business, and it's not significant enough of a shutdown to qualify you for the credit. So that's kind of how this nominal versus not a nominal portion of your trade or business concept works. One other item we want to point out, and what's listed in this notice 2021-20, is it does talk specifically about teleworking employees and basically some factors to determine whether having employees forced to telework may be considered a full or partial shutdown of a portion of your trade or business. And things that you need to consider are basically the employees' teleworking capabilities. So do you have a sufficient IT support in place to allow for teleworking? Are you able to perform the same type of work remotely as you would in an office or a regular workspace? And whether the employees need their personal workspace, or if it's really beneficial or convenient to have those workplaces. If it's really just beneficial or convenient, that type of teleworking won't qualify as a shutdown. But if it's really critical to the work being done, then it should qualify for the shutdown. And this is kind of a hot button issue where, a lot of businesses that don't qualify under the second provision, which we're going to talk about in a second, want to try and get within this governmental shutdown concept. There's a lot of examples in this notice 2021-20, which we linked in this presentation. If there's any questions at all, we encourage looking, through those examples. They give a lot of information. So moving on to the next, so if the next qualifying test is whether or not an employer had a significant reduction in gross receipts. And the test for whether or not you had a significant reduction in gross receipts is determined on a quarter by quarter basis, and it's done by comparing that quarter that you're looking at with the same quarter in 2019. If the business wasn't in place, in existence in 2019, for 2021, you can compare the 2021 quarter with the 2020 quarter. In addition, in 2021, they also allowed for this alternative quarter election, which basically allows businesses to use the immediately preceding quarter to determine their eligibility in that quarter. So for example, if you're looking at quarter one of 2021 and you only had a gross receipts reduction that's below the threshold for 2021, but if you look at quarter four of 2020 and if that quarter has more than in 2021 it's 20%. So let's say quarter four of 2020 had a 30% reduction in gross receipts when compared to 2019 quarter one, you would qualify in quarter one of 2021 then. This alternative quarter election is not you really don't have to do anything to make it. You don't have to, file an affirmative election or anything like that. You make the election just by taking the position. And once you make the election, you aren't forced to continue that election. So when you get to quarter two of 2021, if you qualified in that quarter, it's not like you have to go back then to Q1. You would still qualify in Q2.
Hey, John, just want to jump in here and let folks know the first polling question's up in case you didn't see it. And just make sure when you answer it, you hit submit at the bottom. I traditionally don't hit submit and don't get credit for the question. So just something to think about.
Thanks, Nevin. The other concepts that I want to cover are, they're not really related to qualification of the credit, but they are still related to the computation of the credit you're allowed. And really the big factor is number of employees. And the ERC looks back to section 4980H, which has kind of a different calculation of employees than most people consider. I think when a lot of people think of employees, they think about full-time equivalent employees. This is a little bit different, where it's going to look at each employee and how many hours they worked in a week or in a month. And basically each employee is either going to be counted as one employee if they exceed the threshold, or 0 employees if they don't exceed the threshold. There's no partial employee concept here. So basically you're going to add up all your employees for each month, get the total in 2019, and divide that number by 12 to determine how many average employees you had per month in 2019, and that's going to be a determining factor for how much of the credit you could take and what your qualifying wages would consist of. So moving on, the last concept, qualified wages. Depending on the number of employees, if you're under a certain threshold, you're going to be considered a small employee, and qualified wages are going to include all wages and qualified health plan expenditures for all of your employees. Where if you're over that threshold, then you're going to be considered a large employer, and you're only going to be able to claim qualified wages, which is what you get the credit on, for wages and qualified health plan expenditures paid to employees that are not performing services, so basically being paid to stay home. And with that, I'm going to turn it over to Robert. He's going to touch on taxpayer aggregation, which I don't think we talked a lot about in the last session we had.
Yeah, thanks, John. So as John said, we're going to talk about some of the aggregation rules for purposes of the ERTC. This question has probably been one of the more significant questions that we've had. A lot of questions center around the concept of full or partial shutdown related to government orders. But then once we kind of get to, past that point, or we know we're going to qualify under the gross receipts, the next question is often, what other businesses potentially do I need to consider for the credit? So the aggregation rules are really looking at a couple different code sections to determine what businesses all need to be pulled together to look at some of the concepts that John talked about before. The aggregation rules really come into play for a number of different concepts here. One, to determine the number of employees that are included, and whether you're a large or small employer. 2, the gross receipts test is affected by the aggregation rules. 3, whether there's a full or partial shutdown related to the employer or the trade or business. And then 4, really related to the maximum amount of credit that the employee or the employer can take on any employee. So when we're talking about aggregation, the CARES Act and the subsequent legislation really look at a couple different code sections, section 52 and section 414. So these code sections are really applicable in a number of different cases in the tax law, but specifically related to this, section 414 is really looking at the affiliated service group rules. There's 3 different tests under section 414M that look at it. 2 of the tests have a common ownership requirement, as well as interrelated services between the businesses. The 3rd test under the affiliated service group rules is actually really has no common ownership, but it has a management function component. So if one organization is providing management functions to another organization, they might be considered an affiliated service group. Section 52 is probably the area that we've dealt with most for purposes of discussion of aggregation with clients as we've been looking at this and working through this with them. And this is really kind of what I think most people think of related to controlled group rules, which is the entities owning each other, or you have common ownership amongst a small group of people that have various entities. So even though the entity might not own another entity, you might have a couple individuals that own various entities, and whether we need to pull them into one group for purposes of this testing. So section 52 is kind of where we're going to spend a little bit more time here today, because like I said, that's probably the area that we've had to deal with most in some of these discussions. And there's two parts of section 52 that we've worked through. Section 52A, which really is looking at corporations. So if you're dealing with multiple entities and they're all corporations, we're going to be looking at section 52A, and that's going to work us through whether we have a parent subgroup or a brother-sister entity, or a controlled group, or a combined group, which is basically a combination of parent subs and brother-sister entities. Section 52 in itself doesn't really provide a lot of the rules. What it really does is it refers you to another section of the Internal Revenue Code, section 1563, which go through for corporations what a parent-sub relationship is, what a brother-sister relationship is, and what a combined group relationship is. But there are some modifications to the rules under 1563 that are provided for in section 52A. So it's important when you read this to determine what the modifications that are important are. Section 1563 generally looks at an 80% test. So if you have a corporation own more than, or at least 80% of another corporation, you have a parent sub. However, section 52 makes some modifications to this and basically says if instead of you take out the at least 80% test of 1563 and you put in more than 50% test. So you got to change those definitions as you're looking through it. And it's now a more than 50% test as opposed to a at least 80% test. So that's really important in some of these analysis because clearly you could be over 50 and less than 80 and you want to make sure you're looking at the right rules. So one of the easier ones I think probably to look at here is the parent sub group. And that exists basically under 52A and 1563 when you have one corporation own more than 50% by vote and value of a subsidiary corporation. So you just think the common situation you might think of is you have a parent corp that owns 100% of subsidiary. That would be a parent sub. But you also got to remember that you only have to own more than 50%. So if parent owns 51% of subsidiary, you still have the aggregation rules that kick in for purposes of the ERC. The other one that's a little bit more of a test to work through is the brother-sister situation. So under 52A, if you have two corps that are owned by the same 5 or fewer taxpayers, and we're looking really at individuals, trusts, estates, situations like that, but 5 or fewer owners own more than 80% of both corporations. And when you look at their common ownership amongst the corporations, they own more than 50%. So it's an 80% test as well as a 50% test. And we have actually a slide on the next one that'll kind of work through kind of how this generally works a little bit clearer. But there's 2 components of this. And you'll see on the next one that even though the same group of people might own more than 80% combined, they don't meet the 50% component of the test that you have to work through. So that's kind of the common ones there. Like I said, there's also the combined group rules, which is basically just a combination of the parent sub and brother sister situations. So we don't really have an example of that in here, but if we have situations where you have a parent that owns a sub and there's also another entity that might be a sister entity, you got to make sure you work through those because instead of just the parent sub being pulled in, you might have to pull in all 3 entities. The other area under section 52 is 52B. This really addresses the situation in the parent sub brother sister context when we don't have all corporations. So if you have a partnership that's owned by 2 people and a corporation that's owned by the same 2 people, you're going to be looking under section 52B as opposed to 52A because we're not dealing with all corporations. The rules here are very similar, but there can be some differences, and I think we touch on a little bit of that in a couple slides. But generally speaking, the concepts are very similar for purposes of that test. So we'll go to the next slide here. This kind of walks through a couple aggregation examples. On the left, there's two examples of situations where we would have to aggregate the businesses, and then we put one on here to show when you don't have to aggregate it. So on the far left, this is the kind of the common parent sub situation. We have parent corp that owns 100% of subsidiary corp. This is a situation where we do have a parent sub situation. This parent and subsidiary would be aggregated for purposes of the ERC credit, which means we need to look at them as one employer for purposes of number of employees, gross receipts test, whether there's been a partial or full shutdown, and how much of the credit we can claim. I'll also point out there is another polling question open, so please take a moment to answer that. And as Nevin pointed out, you do have to hit submit after you check your answer. So the next part of this aggregation example, it's kind of the same situation on both sides. We have an example where we have to aggregate the entities as brother sister, and then we have an example where we don't have to aggregate the entities as brother sister. So the first example is we have two LLCs. They're triangles, so they are treated as partnerships for tax purposes. Both LLCs are owned 50% by A and 50% by B. So if you remember back to the previous slide, I said there's an 80% test and there's a 50% test. So the first test, the 80% test, we're going to look at whether 5 or fewer individuals own more than 80% of these LLCs. Because A and B each own 50%, we have 2 individuals that collectively own 100%. So the 80% test there is met. The second part of this test, though, to determine whether we have to aggregate them, is we have to look at the lowest ownership of A between LLC 1 and LLC 2, and the lowest ownership of B between LLC 1 and LLC 2. This example, they both own 50%. So when we combine their ownership, A owns 50% of both of these entities, B owns 50%. So that adds up to 100%. So in this example, we meet the 80% test because we have 2 individuals that own more than 80% of LLC 1 and LLC 2. We also meet the 50% test because those individuals' lowest ownership add up to more than 50%. The second part of this test becomes a little more clear here when we look at the non-aggregated taxpayer example. Same example here, we have 2 LLCs, LLC 1 and LLC 2. Both of them are owned by A and B. However, the ownership isn't 50-50 in both. A owns 80% of LLC 1, 20% of LLC 2, while B owns 20% of LLC 1 and 80% of LLC 2. So the 80% test here, which is the first one, which we're going to look to see if 5 or fewer people own more than 80%. We meet that because A and B both own 100% of both of LLC 1 and LLC 2. Why this is not aggregated, however, is because we don't meet the 50% test. Because when we look at A's ownership in LLC 1 and LLC 2, the highest common ownership of A in both of these is 20%. Because A only owns 20% of LLC 2, that's its highest common ownership percentage. The same thing with B. B's highest common ownership percentage is 20% as well, because that's its lowest ownership in LLC 1. When you add these up, even though A and B both own in total 100% of LLC 1 and LLC 2, they don't meet the 50% ownership test because B's highest ownership is 20, A's highest common ownership is 20, so they only add up to 40%. So this is where the aggregation rules kind of get a little tricky when we're looking across the spectrum of a small group of people potentially owning a number of different entities that aren't in the parent sub situation, but they're in a brother-sister looking situation, because you got to look at both parts of these. And in this example, LLC 1 and LLC 2 would not be aggregated for purposes of the ERC. So they would be a standalone employer and have to determine whether they qualify and what their credit looks like on their own basis. So initially, a lot of people, I think, focused on one piece of the aggregation rules, and they thought, okay, aggregation is bad. We want to be a small employer, and if I have to aggregate all my entities, I might not be a small employer anymore, depending on how my employee test goes. However, the aggregation concept can be a positive or a negative depending on your specific situation, because a business that on a standalone basis may not otherwise qualify. So if you take a business that didn't meet a significant reduction in gross receipts, and maybe wasn't subject to a government order because they were considered a essential business, they may not qualify. However, if they have let's say a sister entity that meets the brother-sister test and we have to aggregate them, if that sister entity maybe was subject to a government order, or it met a significant decline in gross receipts, that when we pulled these entities together and tested met the the 50 or 80% test, depending on whether we're talking about 2020 or 2021, both businesses may qualify. So there's a chance that the qualifications of one of these entities in the aggregated group could expand the eligibility to multiple entities. So that's obviously a good situation. There are times where aggregation can lead to unfavorable results. You could have a business that otherwise qualifies, but when we have to aggregate them with other entities, maybe they become a large employer and their credit's limited to wages paid to people for not performing services, as opposed to being a small employer where you could get it for the wages paid to all employers. So that's something important to keep in mind. We got to look at the other businesses, and whether we have to pull them in or not may be a positive or a detriment to various businesses. The other important thing is that we've kind of looked at quite a bit and had the conversations with clients or looked at it is private equity situation. So a lot of times you might have private equity own a number of portfolio companies. And the aggregation rules related to private equity may be a little bit different than if we just have a number of corporations. Most of the time when we're looking at the corporations, we're just looking at the ownership. We can test brother, sister fairly easily. The rules with private equity, a lot of times which operate as partnerships, can be a little bit different because the rules under Section 52 really talk about trader businesses. There's opportunities or potential that a private equity fund itself isn't a trader business and may not result in the aggregation of some of its portfolio companies that on its face might look like you need to pull in. Again, whether you aggregate or whether you have to aggregate or not isn't always clear whether it's a benefit or a detriment. So, just because you're a private equity and you don't have to aggregate, or maybe you're private equity and you do, doesn't necessarily mean one way or the other whether it's a positive or a negative. So those are something to keep in mind as we're working through this, or as you're working through this with your businesses or clients. So just to take a step back, John went through a lot of the concepts here, the kind of the general things people think about. I talked about the aggregation rules. Those are all kind of things leading up to whether you qualify and how much of the credit you can qualify for, and they're important to understand before getting there. Just to spend a few minutes here, obviously, I think most people are aware that the Employee Retention Credit was created by the CARES Act in March of 2000. And as John pointed out earlier, this was really a way to kind of incentivize employers not to lay people off or force people onto unemployment, because the government was subsidizing the wages that they were going to be paying for the businesses that qualified. The 2020 credit that was originally enacted as part of the CARES Act was a 50% credit on qualified wages. The qualified wages were limited to $10,000 for the period of March 13th of 2020 through December 31st. So what you're really looking at here is a possible $5,000 credit for all of 2020 for any one employee. So, and again, for small employers, based on the employee count, which was 100 employees for 2020, that credit was available for any employee that was working. For larger employees, that credit was available for wages paid to people that weren't providing services. For 2020, there was a 50% reduction in gross receipts, or a government shutdown, which was the rules for determining applicability. One of the big things initially when the CARES Act came out that kind of prevented a lot of people from really looking into this is that if you received a PPP loan, you did not qualify for the ERTC. So that was kind of something that a lot of people didn't pay much attention to, the ERTC at first, or looked at it, determined the PPP loan was a better option, and kind of moved on. And if we go to the next slide, we'll see there's been some modifications to the original Employee Retention Credit that was brought about by the Consolidated Appropriations Act, as well as the Recovery Act of 2021. Some of the changes that were made here is that the gross receipts reduction was reduced from a more than 50% decline in revenue to a more than 20% decline. So now you only have to be less than 80% of your gross receipts from 2019, as opposed to less than 50% of your gross receipts. The other big thing that probably brought this into play for more people, even maybe than some of these other changes, was the fact that PPP loan recipients could now qualify for the ERTC, and that was actually made retroactive. So you could get the credit for 2020 as well as into 2021, even if you received a PPP loan either under the first round or the second round. The qualifying wages also went from $10,000 for the year under 2020. For purposes of 2021, it's actually $10,000 a quarter. And the Consolidated Appropriations Act extended the ERTC through June of 2021. And then the Recovery Act actually extended it till the end of 2021. So now it's available all of 2021, and you can actually get $10,000 per quarter, or $10,000 of qualifying wages per quarter, as opposed to $10,000 for the entire year. The other big change is the credit percentage went from 50% to 70%. So now instead of a $5,000 credit that's available per employee for 2020, you could get a $7,000 per quarter per employee credit for each quarter of 2021. Just a couple other important notes that these two acts brought about. One, you can't claim the same wages for PPP loan forgiveness and the ERTC. So to the extent you needed those wages for PPP loan forgiveness, you can't take them on the ERTC. John will talk a little bit about that interaction here in a few minutes. The other thing is that the statute of limitation for the IRS to look at the payroll credits was extended from 3 years to 5 years. So the IRS now has 5 years that they can go back and look at employment tax returns only specifically related to the ERTC credit. So after the normal 3-year statute of limitation expires, the only thing the IRS can change is changing your ERTC credit, but they have 2 extra years to do that. So that can be very important to keep in mind as we're looking. The statute is actually 5 years. Another polling question is opened up, and we're going to go to one last slide here before I give this back to John. This chart right here just kind of walks through the difference between the 2020 credit and the 2021 credit. We can kind of see some of these columns that go across both spectrums. That's where things didn't really change. However, you can see some of the stuff changed. Significant decline in gross receipts went from greater than 50 to greater than 20. What a small employer is went from 100 employees in 2020 to 500 employees in 2021. The credit percentage, as we talked about, went from 50% of qualifying wages to 70% of qualifying wages. And then, like I said previously, the maximum credit for 2020 is $5,000 per employee for the entire year, where in 2021, it's $7,000 per employee per quarter. So you could get $28,000 of credit potentially per employee in 2021. And there is also another polling question open. Actually, it might have just ended. Hopefully everybody answered those ones. And I think with that, then we're going to go back to John to talk about a couple other items.
Thanks. And before I jump into the next, I did want to make one comment on the qualification and what is qualified wages. Depending on what test you qualify for the ERTC under, whether it's a governmental shutdown or whether it's a decline in gross receipts, the wages that are considered qualified wages for that period will change depending on which test you qualify under. So if you had a gross receipts reduction for a quarter, all wages in that quarter are considered qualified wages. However, if you qualify because you had a government shutdown, only the wages that you paid during the period of that government shutdown qualify for the credit. So it's not necessarily all of your wages in that quarter. If you were only shut down for 2 weeks or 4 weeks or something like that, it's only going to be the wages for that period you were shut down. Just want to make sure I mention that. I don't know how big of an issue that is in 2021, but I know we mentioned on the last presentation we did. So I'm going to be talking a little bit on how you claim the ERTC and just some other things to keep in mind. Claiming it is actually pretty straightforward. You include your qualified wages and health plan expenses on your 941. You don't really have to provide anything else in terms of proving that you had a reduction in gross receipts. You don't have to attach a governmental order or anything like that. You include your amount of qualified wages. It automatically calculates your credit. So you do have to do the computation of qualified wages outside of the payroll return. And that's essentially it. Now, the IRS does provide some worksheets for the Form 941. However, they're not actually submitted to the IRS. And you should work through these worksheets as part of your documentation process and keep these, for your records. So if this does ever get pulled, they may want to see, hey, show me your filled out worksheet 2 from Q2 of 2021 or something like that. So I think different periods have different worksheets available. So I would just look through the 941 instructions. One new thing that we did want to make sure we mention is small employers can request an advance of the credit before the end of the quarter by filing Form 7200 in advance. The payments can exceed 70% of the average quarterly wages paid by the employer in 2019. And there's all sorts of special rules if you weren't around in 2019, what amount of advance payment you can get. But that is available if you don't want to wait till the end of the quarter. I want to talk just a little bit about more documentation. So again, you don't really have to submit much with your 941 to claim the credit, but as Robert said, they are extending the statute of limitations for review of this credit. And we expect this to maybe be a hot topic for the IRS over the coming years. So you do want to make sure you have your documentation in order. So in addition to filling out those worksheets and keeping those for your records, if you qualify under a gross receipts reduction calculation, you should probably maintain a copy of that reduction calculation for your files. Same thing as if you had a government shutdown and you determined that you qualified due to that, you should keep whatever governmental order you were following that allowed you to qualify for the shutdown, as well as if you did any computation trying to determine if a portion of your business was more than nominal. So again, going back to those 10% tests, you should keep those for your records. Any computations regarding your number of employees, so figuring out how many average employees in 2019 you had to determine if you're a small or large employer, you should keep those for your records. And if you went through any testing or your tax preparer went through any testing as far as aggregation goes, you should keep those as well. That's all things that the IRS will likely want to see if they pull your 941 for review. And one other point we want to make clear, claiming this credit is a little bit different than the PPP loan. So after a lot of iterations and a lot of heartburn in the PPP community, eventually they decided that PPP loan proceeds that were forgiven were not considered taxable income. In addition to that, the expenses paid with PPP loan proceeds were still considered deductible. So there was no income recognition event for the PPP loan at all. The ERTC is different, and any wages, basically your deduction for wages in any quarter or period needs to be reduced by the amount of credit you received in that period. So it basically does take some of your expenses and makes them non-deductible. So there is an income tax effect to claiming and receiving the credit. So just keep that in mind. So the last thing that we want to talk about and go through in a little bit more detail than we did, I think, the last time is the interaction between the ERC and PPP forgiveness. As Robert said, they did come out and say you can qualify for both, but basically you can't use the same wages to qualify for both PPP loan forgiveness and the ERC. So this basically created a little bit of complication and creates some required planning to think through, what wages and what other expenses you want to include on your PPP loan forgiveness application, and really trying to maximize either payroll in a period that you don't qualify for the ERC, going towards the PPP loan forgiveness, or alternatively just looking at seeing if you could basically pick out wages for employees over $10,000 for the quarter or something like that, as well as obviously maximizing your other expenses that aren't wages. So in general, for the PPP loan forgiveness, at least 60% of your qualified expenses need to be payroll costs, and the remaining qualified expenditures can be made up of a number of different things. So best practice is, if you're going to qualify for the ERC, or if you're not sure and you might qualify for the ERC, on your PPP loan forgiveness application, you should really try to maximize all qualifying costs available. And the IRS in Notice 2021-20, they did come out with some slightly favorable information that basically says, if included on your PPP loan application, you just reported everything. You gave them all your payroll costs. You gave them all your qualified expenditures. The IRS basically said that they will take the minimum payroll required to get full PPP loan forgiveness and assume that you used other qualifying expenditures to make up the difference. Now, the one problem that comes with this is, if you didn't include everything on an original PPP forgiveness application, if you only included payroll costs, which you may have done because you didn't know that this rule was going to exist, because again, they changed the rules kind of on the fly. So if you only submitted a forgiveness application with payroll expenses, even though you had other qualifying expenditures, there's really not much you can do about it. The IRS is basically saying at this time, you're limited to what you actually included on your forgiveness application. So keep that in mind. And we're going to go through a couple of quick examples related to this, just to kind of highlight how this is going to work. So, and these are examples directly from the notice. So in example 3 here, an employer received a PPP loan of $200,000. They had $200,000 of qualified wages, as well as $70,000 of other eligible expenses outside of wages. In their loan forgiveness application, they only reported the $200,000 of qualified wages. They didn't report the other eligible expenses of $70,000. In this case, this notice said that the entire $200,000 reported is not going to qualify for the employee retention credit, even though there were $70,000 of other expenses that existed. If you go on to the next example, it's the exact same set of facts, but this employer, instead of only submitting a loan forgiveness application with $200,000 of wages, they also included those $70,000 of other eligible expenses. So in total, they showed $270,000 of eligible expenses, even though they only needed $200,000. In this situation, only $130,000 of payroll costs are actually required for full PPP forgiveness, because they have that other $70,000. So the remaining $70,000 of wages in this example would potentially qualify for the retention tax credit. Obviously, you still need to go through the tests, and you still need to look at the amount of wages per employee, but those wages may qualify. And then I put together an example of just looking through some different quarters and thinking through basically some different planning techniques to try to maximize both the PPP loan forgiveness as well as the amount of the credit you can get. So in this example, I kind of listed out an employer with 5 different employees over 2 quarters, and basically some tactics you may want to do. Now, if in this example, quarter 1 and quarter 2 were essentially your covered period, what you're going to want to do here is the first thing you'll want to do is look at each employee, and if you qualified in Q1 and in Q2 for the ERC, you'll want to look at each employee and say, okay, the first type of wages that I want to apply towards PPP loan forgiveness are any wages of any employee over $10,000 in a quarter, because those aren't going to qualify for the ERC since it's limited to $10,000. So right off the top, you've got $2,000 from employee C in both quarter 1 and quarter 2. You've got another $5,000 from employee D, and then you've got $10,000 from employee E in quarters 1 and quarters 2. So in this example, you need to get it up to a total of $36,000 of wages for full PPP forgiveness, and we just carved out $29,000 of wages without eating into our available ERC for those 2 quarters. Now, from that point, you're going to need to, unfortunately, eat you will need to eat into that ERC to make up that additional 7,000. But if you change the example and you say, rather than saying we qualify for the ERC in both quarters, maybe we only qualify in Q1 and not Q2. Well, then you're going to want to take your Q2 wages and say, those are the wages that we're applying for PPP forgiveness, and we're going to maintain those Q1 wages. The notice does give you that kind of flexibility that you can kind of pick and choose the wages in your covered period, and really try to maintain as much in terms of qualified wages as possible to maximize that credit. So that's something you want to think through. I think that's everything I wanted to cover. As far as ERC versus PPP, obviously you got to work through, some different formulas, make sure you're maximizing those dollars. In the back here, we do have a couple different flow charts that I think a lot of people have utilized, both for 2020 and 2021, because the rules have changed. Again, these are included in the materials. So if you're just starting the process of trying to determine if you think you qualify, these are a really good place to start. Robert, I don't know if you have anything you want to add to these.
I don't think much. I think it, like John said, I think it's a good way to kind of walk through and see where some of your areas that you need to address or figure out whether you qualify or not. But there is one for 2020 and 2021 that kind of gives, kind of a summary of some of the pieces that we just went through, asking the questions that may be a little easier than just sitting there trying to work through all the different components we talked about before.
Great. John, Robert, thanks for that presentation. I guess we got a couple questions coming in here, and we have some that I know were asked in advance that I want to be able to shoot over to you guys here with the remaining time. One, I guess the first one that I guess is ultimately it's coming from me, and I think one of the most common questions I get asked, and you did touch on it in your presentation, so I want you just to highlight it one more time. But I get the question of how are the employees calculated to figure out whether I'm a large employer or a small employer, and hey, I had XYZ amount because of the PPP. Isn't this the same? I know it isn't, but why don't you highlight that one more time? Because I feel like that's a common question I get asked.
Yeah, so as John talked about a little bit earlier, we don't have, it's different than the PPP calculation, so keep that in mind. And as John really pointed out, there's a full-time employee calculation for purposes of this analysis. And it's not full-time, meaning 40 hours a week or anything like that. The test is really 30 hours. If the employee averaged 30 hours a week during the month or worked more than 130 hours for the month, they're considered a full-time employee for that month. If they're under those thresholds, they are not counted. So it's not, I have two people that work 15 hours a week, are they one employee? You're either a full-time employee for purposes of this or you're not. Once you determine how many full-time employees you have under this 30 hours, average 30 hours a week for the month or 130 hours total for the month, then you add up all your months together and say, how many employees did I have each month? You take that and you divide it by the number of full months that you're in operation. So if you were in operations all of 2019, you would take your total employees for each of the 12 months that you calculated under this test and divide it by 12. If you were only in business for 6 full months during 2019, you would take that and you would divide it by 6. So there's a different component to it here. You could have almost essentially no full-time employees if you have a lot of people that work 20 hours a week. They wouldn't be included in this calculation.
Yeah, and something to add, Nevin, the PPP number of employees was different. I'm pretty confident that was a full-time equivalent test. So it is going to be different. And the one other thing I want to mention is this 4980H section that it is in an Affordable Care Act section, and there's actually a pretty significant list of FAQs on this topic, and a lot of it goes into how do I calculate my employees and how do I add in things like vacation time, paid time off, if I share employees with among multiple entities, how do I count their hours? So there's a lot of information out there. So if you do have a more complicated example and you're up near the threshold limit, that's probably going to be something you want to work through either with your tax team, or whoever your contact is to try and make sure you're encompassing all the employees you should.
Great. Another one I get asked. I made an acquisition in 2020. How does that factor into the measurement of a potential revenue decrease?
Yeah, so there is actually a specific example in Notice 2021-20 that talks about acquisition situations. And you basically can handle it one of two ways. So if you acquired a business in 2020 or 2021 that was obviously in operations but owned by somebody else during 2019, they provide you a safe harbor method that basically lets you, if you have the information available to determine what the gross receipts for the 2019 quarter that you're looking at for the business that you bought, you can include those in your 2019 base for determining the reduction. And then what you're going to do is you're going to take your, the acquired businesses 2020 or 2021, depending on what quarter we're looking at, gross receipts, and you're going to compare those. So you essentially get to add them to yours. If you do this, they call it the safe harbor method. You look at the entire quarter that you purchased the business in. So if you bought a business, let's say February 1st of 2021, you're going to look at, your business's first quarter of 2019 plus the acquired business's first quarter of 2019 and compare that to the entire first quarter of 2021 for your business in the acquired business. If you don't go under the safe harbor method because you can't get the gross receipts for the quarter of 2019 from the business you're buying, or you choose not to, you still have to take the acquired business's gross receipts into account post-transaction. So if you just go back to my example, you bought a business February 1st of 2021, you have to add their gross receipts from February 1st through the end of March for your first quarter calculation, and compare that to only your first quarter calculation from 2019. So it makes it harder if you don't have the information to look at their sales from 2019, because you can't disregard them when you're calculating whether you qualify in 2021 or 2020, depending on what quarter you're looking at. So you have to factor them in. It's just a matter of whether you can factor them into your 2019 base because you have the information available or not.
Okay, thanks. I think we got time for one more, and then we'll give maybe everybody back a couple minutes here. So can I use wages paid to an owner of the business as part of calculating the employee retention credit?
Yeah, so this question's a little bit vague, and it doesn't specifically address it anywhere in the frequently asked questions or the notice 2020 or 2021-20. But there is a provision in the Act that limits certain related parties, and they reference code section 51I, which is related to the work opportunity tax credit, which is where they pull some of these rules from. And in that, it does limit certain related parties. It doesn't specifically address owners themselves. However, there are some articles and commentary, and there's some legislative history and interpretations by the government out there that do say that owners would be prohibited if they own more than 50%. So there's kind of the 50% test out there. I can tell you there's not really any cases or rulings out there that I found, but based on some of the history and the interpretation of some modifications they made to the work opportunity tax credit, it appears as that the government's position is that if you own more than 50% through some of the attribution rules under the work opportunity tax credit, you wouldn't qualify for those. The owner's wages wouldn't qualify. However, under 50% doesn't seem like there's a limitation.
Great. I think that's it for us. Again, I want to thank everyone for their time and attention today. Certainly, you guys got any questions, feel free to reach out to any of us or anyone on the Cohen team. Jennifer, do you need anything formally to wrap this up?
No, thank you, Nevin. We just want to thank everyone for joining us today, and we hope to see you next week for the third program, Cryptocurrency Taxation 101, next Tuesday, the 27th at 12 noon. Thank you.